Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Great Eagle Holdings Limited annual report. Great Eagle Holdings Limited is a diversified investment holding company that provides a wide range of businesses and services across various sectors. At the core of its operations are property-related activities, including hotel operation, property investment, development, and leasing. The company owns and operates hotels under renowned brand names such as the Langham, Cordies, and Eaton. In addition to property management, Great Eagle Holdings also offers flexible workspace operation services, property agency services, and maintenance services. Its portfolio of businesses extends beyond real estate to include hospitality services, hotel management, and general trading. The company's expertise in property investment is further complemented by its involvement in asset management, warehousing, and procurement. Furthermore, Great Eagle Holdings provides a range of support services, including secretarial, staff, repair, consultancy, and advisory services. Its financial services arm offers treasury management, investment fund management, and computer system services. The company also engages in securities investment and operates beauty stores, demonstrating its diversification into various industries. In terms of real estate investment trusts, REITs, Great Eagle Holdings manages Champion REIT and U.S. Real Estate Fund, further expanding its reach in the global property market. Its medium-term note issuance program allows it to access capital markets for funding requirements. Overall, Great Eagle Holdings Limited's extensive portfolio of businesses and services reflects its commitment to diversification and growth across multiple sectors. Great Eagle Holdings Limited market capitalization of $12 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Great Eagle Holdings Limited holds a significant advantage in their industry. Great Eagle Holdings Limited trades at a higher price-to-book ratio of 0.24 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 39% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 6.64%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. On the growth side, core business revenue saw a significant increase of 114.6%, while statutory accounting principles, revenue grew by 80.7%. Revenue from property sales skyrocketed by 650.4%, and distribution income from LHI rose by 100.8%. Hotels EBITDA also experienced a notable increase of 20%, along with management fee income from Champion REIT, which grew by 10%. In addition to these key drivers, revenue from other operations saw a growth of 26.6%, hotel room revenue increased by 44.6%, and the sale of properties rose by an impressive 648.3%. On the other hand, rental income from investment properties declined by 9.1%, building management service income decreased by 11.7%, and dividend income fell by 12.1%. Geographically, Hong Kong was a significant contributor to revenue growth, with a staggering increase of 443.8%. The United States also saw a notable rise in revenue, growing by 192.5%. In contrast, Canada experienced a decline of 6.3% in revenue, while mainland China and Australia saw more modest increases of 5.3% and 6.1%, respectively. Net income experienced a mixed trend over the period in question. Initially, it increased by 34.4% to $1,087.7 million, indicating a positive growth trajectory. However, this upward momentum was short-lived, as net income subsequently decreased by -9.9% from $396.7 million to $634.5 million. Furthermore, there was an even more significant increase of +100.8% from $39.1 million to $78.5 million. The profit margins also underwent a change in the period under review. The operating profit margin decreased from 41% in 2023 to 20% in 2025, indicating a decline in profitability. Similarly, the core profit margin decreased from 19.8% in 2024 to 24.6% in 2025. This downward trend was also reflected in the consolidated segment results, which decreased by -5.9% from $4,205.7 million to $3,958.9 million. The reasons behind these changes can be attributed to several factors. The exclusion of fair value adjustments had a significant impact on the net income and profit margins. Additionally, ongoing macroeconomic and geopolitical uncertainties affected hospitality demand, leading to rising operational expenses. These external factors contributed to the decline in profitability and net income over the period in question. The company is indeed generating positive operating cash flow. This can be confirmed through multiple sources in the financial report. On page 136, it is stated that the cash generated from operations for 2025 was $34,354 and $6,387,412 for 2024. Furthermore, net cash from operating activities also shows a positive trend with figures of $7,562,863 in 2025 and $5,641,096 in 2024. Additionally, page 263 provides further confirmation that the company has experienced a significant increase in net cash inflow from operating activities, with figures of $711,557 in 2025 and $172,400 in 2024. These numbers demonstrate a clear improvement in the company's ability to generate positive operating cash flow, indicating a strong financial position. The financial performance of various segments and regions within the company has been mixed. In terms of poor performance, the office segment in Hong Kong, as well as several specific properties such as Lang M Place Mall and 3 Garden Road and Lang M Place Office Tower, have struggled. Additionally, property investment and development have also underperformed. On a more positive note, the hotels division has shown stability with an increase in EBITDA of 4.3%. Serviced apartments in Great Eagle Center have performed resiliently, while the residential property pool has seen success with the acquisition of 134 units, generating $3.4 million net rental income. Champion REIT and U.S. Real Estate, USRE, have also demonstrated good performance, with Champion REIT achieving a profit before tax of $416,550. Lang M's strong performance is mainly due to rental income from 3 hotel properties. Management is optimistic about the company's future despite facing a challenging operating environment. They have declared a distribution per share stapled unit of HK3.2 cents for 2025, indicating a commitment to shareholder value creation, page 23. To enhance returns, the company has been prudently investing in quality short-term bonds and equities, page 31. The company's vision is centered around sustainable growth, where information flows freely and the world becomes more interdependent. This growth will be achieved through meaningful business practices that benefit both the company and society, pages 38-39. To drive this growth, the company will focus on digital transformation through IT management and strategic direction, particularly in mainland China and supplementary global exposures, page 92-94. Management acknowledges potential risks from market and economic factors, government policies, and corporate performance. However, they are confident that brand and communication initiatives will drive revenue growth and strengthen their market position, page 102. The company is also taking proactive steps to mitigate climate-related risks by expanding its climate-related risk assessments and conducting physical climate risk analyses for major assets, page 106. Overall, management strategy is centered around long-term value creation through sustainable growth, digital transformation, and responsible business practices. They are committed to allocating resources effectively and focusing on key areas to drive revenue growth and strengthen their market position. The company has made several strategic acquisitions and divestitures in recent years to expand its business and optimize its portfolio. In terms of acquisitions, the company has purchased over 100 residential units for long-term investment purposes. It has also acquired office floors in prime locations such as Central and Admiralty, with another floor added in February 2026. Additionally, the company has invested in development projects in various areas, including Kai Tak, Ma Tau Chung, and Choi Hung. Furthermore, it has expanded its residential property pool by acquiring quality residential units from both first-hand and second-hand markets. The company has also made strategic investments in the hospitality sector, with plans to open 8 to 10 new outlets of the Ying Flow brand in mainland China's selected service hotel sector. On the other hand, the company has divested certain assets through sales. In 2025, it sold properties worth HK 10,059,003 and goods worth HK 170,888. These transactions demonstrate the company's ability to adapt its business strategy and optimize its portfolio by disposing of non-core or underperforming assets. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which has been a recurring feature in the company's history. As indicated by specific page references, dividend payments have been made on numerous occasions, demonstrating a consistent effort to reward shareholders for their investment. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. A notable instance of this is mentioned on page 233, highlighting the company's proactive approach to managing its capital structure and enhancing shareholder returns. Concerns over inventory buildup and supply chain disruption have been raised in various sections of the report. Inventory levels appear to be increasing, with distribution income from LHI suggesting a significant rise on page 11. This trend continues throughout the report, with accumulated sales reaching 717 residential units by page 17, indicating some level of inventory buildup. Elevated inventory levels are also affecting Hong Kong's office sector, weighing on its performance as noted on page 33. Furthermore, an increase in inventories from $97,663 to $69,325 is observed on page 132. These findings suggest that inventory management may be a pressing concern for the industry. In addition to inventory buildup, supply chain disruptions are also a concern. The operating environment has been impacted by room rates and occupancies, possibly related to supply chain disruptions, as mentioned on page 23. Supply chain disruption is explicitly mentioned on page 103, highlighting its potential impact on the industry's performance. That concludes the financial summary for Great Eagle Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.